Saturday, October 20th, 2018, Maneco 64, home of alternative economics and contrarian views. Today I'd like to talk about how the financial sector has completely taken over the real economy in the US in the last 50 years through the withdrawal of the gold anchor in 1971 when Nixon closed the gold window, through the deregulation of the financial markets and financial system, through the repeal of the Glass-Steagall law by the Clinton administration. And it's quite amazing. I've gone through the numbers. I'll show you some charts. But before I start though, I'd just like you to update on a couple of headlines and some news that came out late yesterday. The first one is about Italy, and I thought it was surprising that in the last hour of trading or so in Europe, that Italian bond yields dropped like 20 basis points. We closed below 350. It was trading above 370 earlier in the day, and I thought this is quite unusual for this to drop on a Friday, just on the close, with a lot, with all that could come out during the weekend. And lo and behold, right after the markets closed, Moody's downgraded Italy's debt rating to 1 notch above junk. So it will be very interesting to see how Italian bonds open on Monday. If the yields spike a lot higher, was this manipulation by the Italian Treasury, or maybe even the ECB? Maybe they got a nod from Moody's. Who knows? But I thought that was weird at the time. Lo and behold, was because of Moody's. The second story or news that came out yesterday, and it comes out regularly, is the commitment of traders report from the CFTC as it pertains to the gold futures and the silver futures. And the data that came out yesterday is for the gold market and the silver market, futures market, up until as of the end of day Tuesday last week. So it's a bit delayed. What's very interesting is that people have been talking about how the commercials, who are the bullion banks, have been going long gold and silver. And they've never been as long for over 15 years, in the case of silver for over 20 years. You can see here that from the previous Friday, in silver, the commercials were long 78,165 and short 74,610. So almost 4,000 net long. But as of Tuesday this week, which was reported yesterday, that has switched around. You can see the commercials have added 7,836 shorts. So they're now almost 5,000 net short. So that will be very interesting to see what happens going forward, even though this was as of Tuesday and silver and gold actually finished the week quite well. So it didn't seem to hurt the silver market too much. Gold is even more amazing of a change. Last week, gold, the commercials were long 174,309 and short 148,443. So they were net long like 25,000. But then, as of yesterday's report and as of Tuesday this week, they increased their short positions by almost 50,000, and they decreased their longs by 8,166. So now they're short 198,000 versus 166,000 long. So it's like 32,000 net short, but it doesn't seem to have hurt the gold market. As you can see here by the weekly chart, this week gold closed just below 1227, 1226.84. That's the spot price. And the previous week we closed just below 1218, around 1217. So actually, in spite of all the shorting that the commercials did, gold was able to finish the week higher. If you think the Monaco 64 channel adds value to you and you'd like to contribute or help the channel, check the links below in the description. How the financial sector, which and the banking sector, which should be like a utility for the general economy, has actually taken over the economy. And I'm going to use the US example here because there's a lot more data, but I would argue that in the UK it's probably even worse. In Germany and other countries, not as bad as the US or UK. So first of all, I'll show, and the data I took are all from the Federal Reserve Bank of St. Louis. So it's all hidden in plain sight. You just have to look at, research it and dig through the data. So first of all, I want to show gross domestic product. You can see here from it's from around 1945 to present day. You can see that how it's gone up. GDP, it's just above 20 trillion right now, as per annually, as per the last data, 20,411,000,000, so 20,411 billion. And I wanted to look at this because I've been listening and reading some, how can I say, material from an economist at the University of Southampton, Professor Richard Werner, and he talks about how people can guide, central banks can guide credit, even though I'm not going to go into that right now. But it seems to me that in the United States, the credit and finance has been guided towards the financial sector. And so that's why when they tell you, oh, we have free markets in the US, it's not true. It's not free markets. The central bank has been guiding the economy to complete financialization almost. And I'll show it to you by numbers. And what has helped, what have been the instruments that have helped that? Well, certainly taking the US off the Bretton Woods Agreement, taking it the system off the gold anchor has made it easier for the Federal Reserve and the financial sector to expand because they haven't had a limit to how much they can lend and borrow because of the gold anchor. The other factor I would say that was very important, especially in the last 20 years, is the repealing of the Glass-Steagall, which led to the amalgamation of speculation and commercial banking. Prior to that, the big commercial banks could not get involved in speculation, and that has helped the economy, transform the economy, make the economy more based on finance and speculation than on producing real goods. And one other thing I like to add, because you might say, so yeah, so what? Well, Professor Richard Werner, he explained exactly why small and medium-sized businesses, like the mom-and-pop businesses that are not corporations, why they create so much more jobs. And most of you probably know that, but I wasn't really quite sure about the reason, and he explains it really well. It's all about economies of scale, because big corporations, they don't need to, they can always cut, they have economies of scale, so they can always cut, their labor resources, their employees, because they can leverage their operations much easier, so they don't create too many jobs or extra jobs. We've heard, of course, since President Trump has come to power that, oh, such and such corporation has brought 2,000 jobs back. But they don't talk about the fact that these same corporations are probably not hiring new people in terms of when older employees retired. They're not like substituting them. So in the end of the day, it's the small businesses that create the most jobs. because they need the employees. You know, a business that starts out from $100,000, you know, a mom and pop, for example, and then they start doing well, they'll hire another 3 people, and then they do really well, they'll hire another 10 in 2 years' time. So, and you multiply that by thousands, and you get the job creation. And these datas that I've gone through show exactly what's happened and why we still see almost 100 million people out of the workforce. You know, the labor participation is very low. It's in the low 60%. Why shouldn't it be 100%? Probably will never be even in a perfect, well, there is no such thing as a perfect world, but it could be better, right? So I've gone through GDP. So let's get to it now. And I've also written down here some notes about these numbers, because they give the charts, but they don't give some of the percentages. So I'll go through here. So first of all, I want to show you the total credit to private non-financial sector adjusted for breaks for the United States. So again, from the mid-40s up until nowadays, and you can see that as a percentage of GDP, non-financial sector, it had never been above 100% of GDP. Up until the early 80s, it did grow, you know, in the 60s and 70s. But since the early 80s, you can see how it's gone up a lot. And right now, it's around 150% of GDP. But it was almost, you know, 90% of GDP in the 60s. So it has grown. And it has grown particularly more since the early 80s, since you know, the exit from Bretton Woods and the gold anchor. Now I want to show you, this is the amazing one that I wanted to show you. And this is not as percentage of GDP, because I couldn't get that number. For some reason, the Federal Reserve Bank of St. Louis didn't do that as a percentage of GDP. And you might understand why when I tell you the percentages, which I had to calculate by hand. So this is the most amazing one here. You can see that we're hugging near the zero line, and then after the early 70s, mid 70s, you can see that line is growing, and it goes exponential, and it goes up above 18 trillion. And that was at the top, at the third quarter of 2008. And right now we are at 16 trillion. So that has fallen. But I'll go through this number for you as a percentage of GDP. So this is financial business, credit market instruments, liability level. So this is Wall Street, the financial institutions. So I went back and looked at what happened in the 1960s. So I took the data, annual data, at the end of the fourth quarter from 1960 to 1970. I will only tell you the 1960 and 1970 number though. So in 1960, this total credit market financial business was 37.709 billion. And the GDP was 540.197 billion. So financial businesses and credit market instruments and liabilities were 6.98% of GDP. Not bad, 6.98. It's not a dominant percentage of GDP. But then by 1970, prior to the you know, Nixon closing the gold window, this had already started growing, and that's probably one of the reasons why he had to close the gold window. By 1970, the number for financial business was 141.493 billion. GDP was 1,088 billion, or just over $1 trillion. So that number, that percentage or proportion of GDP was 12.99% or 13%. But more interestingly, now we go to 2008 and we do the same exercise, and it's quite amazing. So in 2008, GDP was at 14,805 billion, or 14.8 trillion. And this is the end of Q2, second quarter. While financial business, and get this, financial business was 17,899 billion, 17.89 trillion, or 120.89% of GDP. So it's quite amazing that the proportion of financial business compared to 1960, I mean, look at it, 6.98 in 1960, 120.89% in 2008. Is it surprising that we had that huge financial crisis? And I'll come to the number now. And even though it has gone down as a proportion of GDP, it's still huge. I mean, in 1970, it was 12.99. You know, in 2008, it was almost 10 times that. So where is it now in the latest numbers? Well, the latest numbers, financial business is 16,044 billion. So 16.04 trillion. The GDP has grown to 20,411. So it's 78.6%. So it has shrunk. It has shrunk, and it's been shrinking since 2008 at a steady pace, which is a good thing, but it's still really, really high compared to 1970 at 13%, right now 78.6%. But now to end it all, to end this analysis, I'm going to look at the non-financial, non-corporate business gross fixed investments flow. And that's again from the Federal Reserve Bank of St. Louis. So these are the small businesses, non-corporate business, non-financial. And I went through the numbers again. It was very easy. You know, I took the numbers each decade and I divided by GDP each decade. So I started in 1960. This number, non-financial, non-corporate business, gross fixed investment. And why am I looking at investment? Well, because investment in small businesses create jobs, right? They create the most jobs. So 1960, that number was 15.122 billion. So it was 2.8% of GDP. I guess you could say it's fairly low. But that's what it was. 1970, it was up to 3.1% of GDP. So it was 33.81 billion. Then 1980, it was 3.11. 1990, it started going down. It was 1.99. 2000, it was 2.26, but still below the levels of 1960, 1970, and 1980. 2008, 2.11%. 2010, 1.64%. And the latest number, this proportion is at 2.02%. And you might ask, well, that's good. It's held up quite well. You know, it was 2.8% of GDP in 1960, and now it's 2.02. Well, that's a decrease. That's a fairly big decrease. The other thing that you need to compare with the financial business. So financial business used to be 6.98% of GDP in 1960. Non-financial, non-corporate business investment used to be 2.8% of GDP. And now it's only 2.02, while the financial business now, it's almost to 80% of GDP. So you can see how that's created the huge power for Wall Street, the financial institutions. And that's why the general economy is moribund. That's why the jobs are not being created. Yes, maybe corporations create jobs, but they're not the engine of growth of the economy. You just have to look at Germany, how they've kept that going to some extent through what they call the Mittelstand, the small, medium enterprises, the mom and pop business in Germany. It's because they've guided credit more towards real things, not just the financial sector. And and then they come with the excuse, oh, but it's a free market. We can't guide credit to the real economy, to small businesses. But, and that's rubbish, because they can guide it to the big banks, and that's what they've done for the last 50 years. So that's proof there by the numbers from the Federal Reserve itself. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on Steemit, DTube, and on Twitter. Have a great weekend, and I'll talk to you later. Take care. Bye.